In this session, let's look more in terms of long-lived assets, which are nothing but non-current assets. Right? In the balance sheet, we had quite a few number of items that are going under the non-current assets. The major focus here is both tangible as well as intangible assets. We will not focus much in terms of investments and all, which are also non-current assets. The focus of this session is primarily on the tangible as well as non-tangible, intangible kind of assets. Tangibles are like your properties, plants, buildings, those kind of stuff. Intangibles are your softwares and copyrights and patents, goodwills. Those are the different kinds of. So only to that extent. But a company making investments in some other companies or something, that also goes as a part of non-current assets, but here we will not deal that particular aspect. Now, in this particular session, the major focus, or to start with, we need to understand the difference between what is capitalizing and what is expensing. Let's say we are spending something to buy a particular product. Let's say I have purchased a machine by spending some 50,000 bucks. Right now, if I show that 50,000, there are two ways of showing the 50,000. This is the essence of this chapter. Let's say I have spent, see, when I have spent 50,000 on the inventory, on the raw materials, we said it can be shown either as a part of cost of goods sold or it could be shown in the inventory. The same logic if I bring in for this chapter, what we are saying is whatever the amount I am spending on a product, like let's say a machine, right, not on the raw materials. The only difference between the two sessions is there we are talking about raw materials or semi finished good which actually goes into the product which is getting sold. I mean, I'm not talking anything about in terms of current assets or something. A product which is going a spare part or something that is going into the item that will be sold. Whereas on the other side, let's say I'm talking about a machine. Machine is used to produce the item, but it is not getting sold. It's not the product of the company. Wherever some item is the, see, let's say I'm talking about a bike manufacturing company. The major thing which the company sells is bikes. And whatever the items that go into the bike, maybe tires, maybe spare parts, maybe engine, whatever they are all, we are treating them as inventories. Whereas probably a bike, a plant required to manufacture more bikes, or a machine which can do a automatic fitting of something, right? We are not selling those items, we are using them to produce our product. So those kind are probably some supporting things. Let's say I am purchasing AC for some reason, but my intention is not to sell the AC or something. I'm using it as a part of a production of my product. So all those things, whatever I am spending on them, there are two ways of showing them in the financial statements. One is I can show them in the balance sheet as assets. The other is I can show them in the P&L or income statement as an expense. I have spent on it, right? I can show it as an asset in the balance sheet, or I can show it as an expense in the P&L statement, right? Now, when I show it as an asset, we call it as capitalizing. When I show it as an expense, we call it as expensing. And the basic scenario in case of capitalizing is, if at all I have a feeling, if I am reasonably convinced that particular product will be used for more than 1 year or beyond the current financial year, right? That particular product will be used beyond the current financial year, we can capitalize it. But if it is used everything within the same financial year, whatever I have spent after the end of this financial year, it has I will not use it at all. Let's say though I have spent 50,000 bucks on a computer, if I'm going to use the computer for next 3 years, I may capitalize it. But if I'm sure that I will scrap the computer after 1 year, then I have to treat it as expense in the income statement itself. That's a clear cut difference. But there are some rules coming up regarding them. But on a simple definition kind of a basis, this is what is the definition between capitalizing versus expensing. So when you are doing capitalizing, obviously your assets are higher because you are treating that cost as an asset. So your assets are higher. Assets are higher means liabilities side also something should be higher, which means equity will not increase the liabilities because we are not borrowing anything, right? And why the equity is higher? Because we are not treating that as an expense. We are not treating it as an expense means your net income is higher, profit after tax will go up, which means here the retained earning, profit after tax is again linked to retained earnings. Retained earnings is going up. Retained earnings is as a part of the owner's equity, shareholders equity. So that is going up. So when the assets are going up, something should be balanced either in liabilities or in owner's equity part. Actually, owner's equity is going up, liabilities will not go up. Owner's equity will go up because it will not be treated as an expense, which will result in profits going up, and that increased profit will get translated into increased retained earnings, right? So because of, and even the cash flow from operations will go up here. Why? If I am capitalizing it, non-current asset, difference in the non-current assets go into cash flow from investments. If you remember, where does the, see, all current assets and current liabilities go into cash flow from operations. Non-current assets, they go into cash flow from investments. Non-current liabilities go into cash flow from financing, right? Now that this becomes a non-current asset, it goes as a cash flow from investment, whereas if I had treated it as an expense, P&L statement, it would go as cash flow from operations. And the other day we have seen in the cash flow statement, cash flow from operations is one of the strongest things which every company will look at, because only from there they are computing the free cash flow to the firm. FCFF and FCFE are computed purely from cash flow from operations, not the total cash flow statement, right? And we have also said that free cash flow is one of the powerful mechanisms for doing the valuations of the firm today, right? So if the cash flow from operations is higher, there is a good chance that the company will be valued at a higher price, right? So even from that standpoint, capitalizing your assets will help you out. And one more thing that comes out is, because you have capitalized the asset, the expense is lesser. The expense is lesser means the net profit or the net income will increase in the first year, but that asset has to be depreciated over the next few years, right? Everything whichever you are treating as an asset, there is a depreciation to it. If depreciation means additional expense from the year 2 onwards, which means from year 2 onwards, your profits are going to go down. But in year 1, when you have actually purchased that asset, purchased that product, your profits are going to be much higher. The reason being, simply look at it like this. Let's say my revenues are 100,000 in both the years, this year and next year. Only 2 years I am talking on. 100,000 in both the years. Let's say I have purchased a product worth 50,000 bucks. If I am expensing it, the whole 50,000 comes here itself. And here it is zero, the cost, the expense. So overall, the profit wise, I'll get 50,000 here, whereas here it is 100,000. Correct? Now, when I am capitalizing it, what it says is this 50,000 will go into the assets. If 50,000 goes into the asset, that asset has to be depreciated. So, because we think that it has a 2 years life, what we'll do is we'll put 25,000 as the cost for 2 years. Instead of putting 50,000 as the cost for 1 year, 25,000 will become the cost for 2 years. This is what is the depreciation part. So actually what is happening, your profit in the first year is becoming 75,000, because you're, instead of 50,000 as expense, you are putting only 25,000 as the expense. And in the second year also, your profit is going to the extent of 75,000. So that is what we are saying. In the first year, your profits are higher, whereas from the subsequent years, your profits will go down. So companies, for short-term purpose, to show very high profits in probably in a year, if they are not doing much better, if their profits are much lesser, to show a higher profit in a particular year, they may resort to this kind of a manipulation. They may treat a particular purchase cost as a capitalization, though everything has to be expensed in this year itself. Right? Okay. Now, there is some benefits. Of course, some of them can definitely be capitalized. There are some benefits associated with the capitalization, as we have seen, because from company's standpoint, they can very well show higher profits because of capitalization, which probably from, and even the cash flow from operations will go up, which means there is a possibility that the financial analyst will value the firm at a higher price. Right? Then one more aspect in the same context is interest during the construction period. Let's say we are talking about a long-term capital project, a big real estate construction project, right? Those kind of projects typically incur a very heavy borrowings also, which means there is a huge, let's say some company has borrowed 2,000 crores for building, let's say an airport, right? An airport is getting developed with 2,000 crores. That, let's assume that 2,000 crores is taken in the form of a loan. Even if I go for 10% interest, 200 crores is the interest per year. But typically, the airport, to become operational and get first revenue, it will take at least 5-6 years. Right? Let's say to just become operational, it will take 5-6 years. And we have said the revenue recognition, probably for those kind of projects, I may do it on a percentage of completion kind of a basis, or those kind of stuff we can very well do. But whatever the interest that has come on the borrowings during that period, what it is saying is, even you borrow for the interest also. You borrow because you don't have any money, right? Right? Your first revenue will come only after 5 years. Right? But the bank will not wait for 5 years for the payment of interest. So what the mechanism is saying is, whatever the interest part you have to pay, let's say 200 crores for the next 5 years. So which means as a part of your borrowing, add up another 1,000 crores. Don't borrow 2,000 crores, borrow 3,000 crores. So that 1,000 crores you can pay as an interest. So you adjust the things in such a way that whatever is the interest for this accumulation period where you don't get any revenues, even treat that as an extra cost, extra investment from your side, and treat that also as an asset and depreciate it from the year when your revenues are started flowing. Treat it as an expense, not from year 1, but treat it as an expense from year 6 where you are actually getting your revenues. That is what we are calling as capitalization. So even it is, so generally what, see, when I spend something on it, when I spend something on it, I can decide whether to capitalize it or expense it. Assume now I am paying the interest to the bank. That interest payment is also like a spending, right? Now I can decide whether I should capitalize it or expense it. And in general, whether it is GAAP or IFRS, both of them allow that whatever the interest you are paying during the construction period, you can treat it like an investment. Probably a simple way to present it is whatever the interest you are paying to the bank during the period where you are not getting your revenues, which is like a during the construction period itself, before the usage starts, where whatever the interest you are paying to the bank, you can treat it as an investment itself, extra investment, and treat it like an asset, right? Just like you have bought a machine, you say you have given something to the bank, though you have given an interest on your loan only, because your loan did not materialize in terms of business still. What we are saying is whatever the interest you are paying during the construction period, you can capitalize it, treat it as an asset. You don't need to treat it as an interest in the income statement